tell us about the key differences between owner-occupied mortgage loans for buying a primary residence and investor mortgage loans for a rental property.
Sure. So I would say that the key things are that on a rental property, probably the biggest difference is going to be that for a rental property, there's additional incomes that potentially we get to use to help offset that new monthly liability, aka the mortgage payment, PITI, principal, interest, tax, and insurance. We have access to income potentially to help offset that. So in the debt to income ratio category, it can be a huge boon or a huge benefit depending on what the individual's qualifications are. Additionally, in that same theme, we're not just confined to a conventional Fannie Freddie loan, right? For investors, we have things like the DSCR, debt service coverage ratio, that you would not be able to apply to a primary residence, but also allows for income to help identify whether the property qualifies for financing.
Yeah, so if a prospective investor borrower is wondering whether they'll have enough income to qualify for that property or not, is it a certain percentage of the tenant's rent income that is used in the investor borrower's qualification income?
Absolutely. So conventional full doc mortgages, they are going to receive in the acquisition year formula, because there's two formulas that will be used in underwriting. One is called the acquisition year. The other one is called the Schedule E. I'll focus on the acquisition year. This is applicable from the date that they acquire the property until that tax year's federal tax return is filed. They get up to, I need to define up to in a minute, they get up to 75% of the gross rents minus the proposed PITI, principal, interest, tax, and insurance. Now I say up to because it depends on two primary criteria that the borrower must possess in order to get the full 75%. So think about it this way, there's three buckets. Okay, the first bucket gets the full 75% of whatever the gross rents are. The easy math example that I give, let's say that the gross rents are $1,000 a month,
Okay.
and the PITI proposed payment is $500 a month. If they're in bucket number one and they get the full 75% of 1,000, they have $750, right? And from that, they're going to subtract out the $500 of mortgage payment. In that example, it would leave them with a gain, a positive $250, right? So that individual came to us with a debt to income ratio of X. As a result of purchasing this investment property, their DTI is going to go down because they're $250 richer, right? Monthly. So 75% is the maximum you can use in the acquisition year. That individual in that bucket has to demonstrate two things. One, they have a primary housing expense, whether that's a mortgage or they rent, either is fine. And then second, they need to be able to demonstrate that they've had 12 months of history in owning investment property. So if they have both of those two things, they get the full 75. If they have one or the other, they're in bucket number two, which gives us an offset. They cannot have the full 75%. They don't get the full gain, but I can offset. So going back to my example, using $1,000 of income and $500 of mortgage payment, they can't have the 250 gain, but I can give them up to 500, making that a zero, right? It's covered completely the mortgage payment. It's not increased any debt or anything in the example. So DTI would stay exactly the same as where they began when we started. And then finally, bucket number three would mean that individuals that have neither of those two things, no primary, they live rent-free, no primary house expense, and they do not have 12 months demonstrated history currently of being an investor, they get zero of the rental income. So they've got to support the full new payment within their DTI and keep it within that 50% threshold. So that was a long explanation to the question, but I think that pretty much covers it.
Yeah, that's really helpful. Okay, that can help the borrower's debt to income ratio. I guess in a lot of cases, it's going to be helping it out by a small amount. What if, say, that investor is buying a new build rental property and there is no tenant, hence no rent income there yet?
I'm so glad you asked. So on a subject property basis, that is the property in which they're purchasing at the moment in time. It's called the subject property. Those properties do not need to be tenant occupied. We can use assumptive rental income from the appraisal on a rental property that will come with some additional forms. Specifically, it's called a 1007. It's just the number on the page. Those are rental income comps. The appraiser has given us an average of what those rents are going to be, and that's what we're going to use the 75% calculation on.
Okay, that's really good to know. New build or a resale rental property, it's going to work the same with either one there. Now, I know oftentimes that one wants to qualify when we look at non-owner occupied properties, rental properties, with conventional conforming loans from Fannie or Freddie. Typically, one puts 20% down on those properties. We've talked before, I think one can put as little as 15% down, although they would have PMI in that case. Or alternatively, rather than putting 20% down, the last time I checked, they could put 25% down and get a lower interest rate. So can you talk to us about the interplay of the percent down payment for a rental property?
Absolutely. More often than not, I'll start by saying more often than not, when you do the math, the capital expenditure, or in this case, the difference between 5% down, 80 versus 75%, divided by the monthly payment difference, you're going to find that the leverage is going to outperform. The higher 80% will outperform the lower 75%. But absolutely, to your point, the payment is going to be less for two reasons at the 75% level. The interest rate will be lower because you've got more skin in the game. The interest rate loan level price adjustment for 75% is going to be more attractive than it will be at 20% down. So the rate will be lower, and of course the loan amount is lower. So both of those combined characteristics are going to create better cash flow, it's true, and a lower monthly payment. However, the math that I always want to promote that people are doing is looking at it side by side. All you have to do, and it's actually much easier than people I think assume. So you figure out the capital expenditure difference. Let's just use 100 grand, okay? Because this math is simple. So you've got $5,000 in additional capital that you'd be bringing to the table for the 75% option, right, versus retaining the 5 grand. And let's just say that the payment difference is $50 a month. Okay, whatever the number is, all you're going to do is take the 5 grand and divide that by the payment difference, and that will give the individual the number of months it takes them to recapture that capital for the savings. Generally, my opinion for an investment property is that if that number is in excess of 36 months, it's going to take you over 30 or 3 years to recapture that capital versus the savings. I'd keep my money because I can do one of a few things with it. If I chose to, I could cash flow the $50 myself every month for 100 months if that was the math. Or I could apply that 5 grand and use it with some other monies perhaps and buy another investment property or put it into a different investment asset class that would provide a return. So more often than not, when they do that math, my belief is when I do it, I'd say even 95% of the time, the higher the leverage is going to be the better return numbers.
Sure. We're philosophically aligned that way. We're leverage proponents here. Typically, the smaller down payment, 20%, is going to be better for you long-term than 25%, even though you'll get a somewhat lower interest rate on a rental property, putting 25% down rather than 20%. When we pull back and we look at the interest rate difference between an owner-occupied property and a rental property, what is the spread between the interest rate? Of course, you're going to pay a higher interest rate on a rental property because it's a lot less likely that the borrower is going to walk away from their own home than they would a rental property.
Exactly. But in general terms, an owner-occupied where you live is typically going to price out an interest rate about 1 percentage point lower than you would find on an investment property. Generally, if we're comparing apples to apples.
Talking about that risk difference for the lender, just like in the 20% versus 25% down example, there's less risk for the lender when you put 25% skin in the game, hence the lower interest rate there too. Caeli, tell us about fitting the right mortgage type to the borrower. And of course, there are so many types. There's 30-year versus 15-year, fixed rate mortgages versus adjustable rate mortgages, interest onlys, DSCR loans like you touched on. So just tell us about getting that right fit for that individual borrower.
Yeah, this is a bit of a rabbit hole. So what I would start by saying is we do at Ridge take a lot of time on the front end and identifying not only what their needs are, their goals are, but obviously what their qualifications are and marrying all of those things together and coming up with a roadmap that I like to call it. So, depending on where the individual is in their journey of real estate investing, as the tax returns may continue to be filed and how aggressive they want to be with, because we maintain and have all of those products, it's very, very uncommon or very rare that we find an investor, potential client, that we do not have some sort of loan product to satisfy what their end game or end goal is. And maybe we continue to graduate them. Let's say that they start in a DSCR because they can't qualify for a Fannie Freddie today, but that is their ultimate goal. We're going to provide them with the insight and the background or the feedback that plants the seeds and gets them to that place in 6 months or a year, whatever. So I hope I answered the question. Depending on their individual needs and goals and qualifications, of course, really will dictate which one of those is going to be applicable.
Well, we've got a lot more to discuss, including, is it easier to approve W-2 incomes from a day job versus 1099 from contract or gig work, and more. We're talking with the nation's foremost expert on income property. She is the president of Ridge Lending Group, Caeli Ridge. More when we come back. I'm your host, Keith Weinhold. We offer free investment coaching. Yes, real estate pays 5 ways at the same time. That's super interesting, but you might not know what to do next. If you're ready to buy income property, our GRE investment coaches have their MBAs. They're real estate investors themselves, and they're here to help you. If you're new to buying across state lines, they hold your hand through the process. If you're a more experienced investor, they help you evaluate the GRE property inventory to help you decide which geographies are most conducive to your goals. Access help and off-market deals by getting in touch with our investment coaches. It is free. So use this resource, take action. You can get started at gremarketplace.com. Welcome back to Get Rich Education. We're talking with Ridge Lending Group President Caeli Ridge. These discussions are great because debt through leverage builds wealth even faster than compound interest, as I've discussed. And Caeli's really the linchpin in her company and help makes that happen with reliable income property loans. And Caeli, today, there are a lot more people with sharing economy income, gig economy income, or doing contract work, and they're paid with a 1099 form that shows their income for that year versus a W-2 employee wage job. So can you tell us about whether it's easier to approve those that have a W-2 income and that versus the 1099?
I don't know that I would classify it as easier or as harder. It's just different. So on the 1099, first and foremost, if you don't have a 24-month history of having that kind of income, you're not going to get a conventional loan. And assuming that we're going to kind of keep on that path, like the Fannie Freddies, because remember, guys, if you can't fit into those boxes, we've got 10 others that we can look to get the financing for. But if we're in the Fannie Freddie, that's really where this is applicable. The 1099 and the W-2, I mean, they're really equal in terms of the overall process. The difference would be that with 1099, you must have that 24-month history, and the calculation is that we're going to take an average. It gets a little bit convoluted, like anything else that is leverage or financing related, but a 24-month average of 1099, unless we can show that that individual, let's say that they're self-employed, okay, and maybe a Schedule C, and they've got their 1099 coming in through that way. If they can show 5-year history of having a license or being self-employed that way, then instead of having to use a 24-month average, we'll use a 12-month average. And that may be to their advantage. Let's say that the most recent year filed is in a bit of a decline from the prior year. Let's just use 22 and 23. Let's say 23 is a little bit lower than 22. A 24-month average is not going to be as big a number than if I were just to be able to take the 12-month average of the most recent year. So if that individual can demonstrate they have 5 years of being or receiving that kind of income, then instead of being a 24-month average, I get to choose and just do the 12-month average. So that would be one thing about the 1099 that I would say. Otherwise, yeah, they're just different. I don't know that one is harder than the other. As long as the qualifications are there, they're there.
When I think about this, I guess it does make sense from the lender perspective. If you're paid and shown income there on your 1099 from sharing economy work, gig economy work, or being self-employed, that's more volatile work than having a day job as an employee.
Sure, absolutely. And if you can demonstrate that you have that history and you've been able to consistently earn and have those numbers, it's okay. Yeah. But without the 24 months, you're not going to get a conventional loan. You're going to have to look at DSCR or something else.
We're talking about what it takes to qualify for income property loans today with Ridge Lending Group President Caeli Ridge. When we talk about that qualification bar that needs to be met, Caeli, you see so many loan applications in there. You have a team, you look at and deal with so many situations. When you're free, you even pick up the phone sometimes yourself and you will talk to individual borrowers. So what do you see in there as the top reasons for not qualifying for an income property loan?
I would say The top reasons for not qualifying for a conventional loan probably is debt to income ratio.
Yeah.
More often than not, of the three basic criteria, which are assets, enough cash to close and reserves, credit, and then DTI, I would say it's the DTI category that more often than not is the culprit for qualifying or not. And it may be as simple as how they filed their last year's tax return and saying, okay, before you file 2024, don't do that until you send Ridge a draft so that we can get ahead of what you may not have known to look for last time. They could be very simple little easy fixes, and sometimes maybe it's they don't want to pay the extra taxes, which sometimes that might be required, in which case we say, okay, let's pivot over to the DSCR options. In which case, by the way, just as a quick sidebar, I'm finding that gap is starting to narrow a little bit to the point that it's a lot more affordable in terms of the investment property and what cash flow is expected than it used to be. The differences between a Fannie Freddie rate and a DSCR rate is starting to narrow a little bit. So if you have to be DSCR, I would not shy away from that just because you assume. I think it's going to be more reasonable for cash flow properties.
Yeah, I'll tell you, when I was an employee as a day job worker grinding in my 8x10 cubicle as it was back in the day, and I was buying income properties, the main thing I would get held up on is that my debt to income ratio, my DTI, was too high, and my salary was pretty strong, although not fantastic, not astronomically high. But I felt like I was a guy that was pretty good, pretty prudent with my finances. And it didn't feel good to be told that, hey, Keith, to lower your DTI, you need to pay off your 3% automobile loan that's at a nice fixed interest rate. I didn't want to have to do that, but I was willing to do that to retire the small loan in order to qualify for the big loan.
That makes sense. I might just offer a comment in that regard. What you may have experienced at that time could have been what we call an overlay in the industry. So,
yes,
like anything, right? Lenders aren't created equal. Because we're so investor friendly and focused, we are going to go by the purest form of those Fannie Freddie guidelines. It's called a seller's guide. And as an example, let's just say that Fannie Freddie gives you 75% of the subject property's gross rents, whereas B of A, or I'm just picking on B of A, I don't know why, but some other lender may impose an overlay. It's like layers of risk and saying, no, we're not going to give you any rental income credit whatsoever, even though the guideline says that we can do it. Our overlay says, no, we can't. So depending on who you're working with, credit unions are a little notorious for that, being a little bit more restrictive in their box of guideline. So it may not always be what you think. So if you've had a lender tell you DTI wise, you don't qualify, but you feel like this is not quite right, you should double check that because it may be an overlay.
Well, everyone is interested in interest rates. It's been so interesting with what's happened the past few years, ever really since the COVID emergency cut took place in 2020, and the volatility that we've seen in interest rates then. We saw interest rates max out in this cycle at about 8% almost a year ago. So what does this declining interest rate environment mean at a mortgage loan company? And what do you see for the future of rates there?
Well, rates have been coming down. If you guys are watching the headlines, you're seeing those sound bites. We have started to see some more refinance activity than we were seeing before, certainly additional purchases as we start to see interest rates come down. I am of the opinion that we're going to continue to see some improvement in the rate department, dependent on some of the jobs reports that we'll be getting soon. So we'll see, but my money is on that we'll continue to see some nice tailwind, not headwind, tailwind in the rate department throughout the rest of the year. And who knows what's going to happen. I mean, this is our election year, et cetera. We'll see how the rest of it plays out.
Well, how does a prospective borrower get their financial house in order themselves before getting a hold of you and your team there? What are some of those checklist items that they should do themselves at home first?
Like I said a bit ago, so you've got those three primary criteria. If you're wanting to qualify for those conventional full doc loans, think about your credit. Do you know what that credit score is? Now, depending on some other variables, it doesn't have to be 800 credit scores to qualify. I mean, we've got clients as low as 650 that are able to get financing conventionally because they've got compensating factors. Similarly for assets, on the investment property side, the down payment and the closing costs and the reserves, none of those things can be borrowed or gifted. And that's very different than if it was an owner occupied. Gifted and borrowed funds are okay for an owner occupied. For an investment property, they have to be sourced and seasoned, meaning your own funds over the last 60 days. So think about that, what your down payment is going to be, get an estimate of closing costs, and make sure that you have the appropriate amount of capital. And then finally, that debt to income ratio. That's a slipperier one to try and calculate that for yourselves. But if you think about your minimum payments on your credit report, that's really all that goes into it. Minimum payments, not the debt load, the minimum payments on the credit report divided by the monthly income, gross income, you should be able to come up with a number, and 50% is that threshold. So if you can kind of just take that kind of mental back of the napkin of your own, you should have a pretty good gauge on whether or not you think you're going to be in this box, or if getting into the game or continuing to be in the game is going to require some alternative loan types.
Inflation's been such a story for the past 3 or 4 years, but some people aren't aware that there's actually been credit score inflation. Last time I checked, the average credit score had been slowly rising in the United States. What's the highest credit score that gets one the lowest rate?
So we're staying in the Fannie Freddie department. 760 and above is all the same bucket. If the individual qualifications are identical, if this one has an 850 credit and this one has a 760 credit, exactly the same in the interest rate department.
All right. And then once they've engaged with you, what about locking in their interest rate? What duration do they have prior to closing? Tell us about that timeline.
Yeah, so an interest rate can be locked on a 15-day lock, a 30-day lock, a 45-day lock, even a 60 or 90-day lock. Typically, it's a 30-day lock. That's the average. The shorter the period of lock, the better the rate and or points that you would pay, and the longer is the adverse, right? The higher the rate or the higher the points. Generally, I like to look at locking an interest rate usually when we get the appraisal back, because an appraisal can be the piece that might delay or there may be some issues.
Yeah.
So I generally like to see the appraisal first. However, we've been in such a volatile area with interest rates and what might be happening and the ups and downs, et cetera. I've broken that rule quite a few times over the last couple of years. I would say today, floating may be to our advantage just because we feel like rates are on the run and that they may continue to improve. Keeping in mind, once you lock in your interest rate, it is locked. Ridge does have a policy that if interest rates were to fall 5/8 of a percentage point or 0.625, you would have a one-time automatic float down option. It's highly unlikely, and that's why we can kind of put that in there. But if it happened, we would honor that. Otherwise, when you're locked, you're stuck with that rate. You can't expect that if an 1/8 or a 1/4 point comes off of, or rates come down that much, that you're going to get a different rate. The only way to do that would be to let the existing one expire for 30 days and then relock market, which is not advisable.
Yeah, you, the investor, has to think about how important a lock really is to you in this declining interest rate environment. Almost everyone expects mortgage rates to fall more slowly than they rose. They spiked up so fast in 2022. Well, Caeli, how does our audience engage with you, get started, and go on their path to getting investment property loans?
3 ways to reach us. Obviously, we've got our website. Please check us out there. There's a lot of good information. ridgelendinggroup.com. You can email us at info@ridgelendinggroup.com. And then finally, toll free is 855-747-4343. 855-74-RIDGE is that easy way to remember. And we'll be here on standby. Thanks, Keith.
Ridge is the same place where I get my income property loans. It's been great having you back on the show.
Thank you.
You can watch this one next.